All right, everybody, welcome back to Talk Tickers. So today we're going to be looking at HCA Healthcare's Q4 2024 earnings call.
Yeah.
And let me tell you, this one's got it all.
Yeah. It's really fascinating to see how they're navigating all these changes. We've got hurricanes, political shakeups, and some seriously impressive growth numbers.
It's wild, right? Like 2 major hurricanes, A&D, a political transition in the same year. Talk about a trial by fire.
Absolutely. Yeah. But even with all that, they still closed out the year. Strong revenue grew by about 6%, driven by strong demand and a favorable payer mix across most services.
All right, so before we get into the weeds, let's hit those top line numbers. HCA's diluted earnings per share adjusted for special items increased 5.4% compared to the same period last year.
Yeah.
That's solid growth.
Yeah, especially considering those hurricanes took a bite out of earnings, an estimated 66 per share, actually.
Oh, wow. So without those storms, their growth would have been even higher.
Exactly. And speaking of those hurricanes, Helene and Adelia had a major impact on their operations. We're talking an estimated $250 million or 2.73 cent diluted share for the full year.
Oof. Those are some serious numbers. But they were able to get impacted facilities back up and running pretty quickly. Mission Hospital in Asheville and Largo Hospital in Tampa come to mind.
Yeah, and that quick turnaround really speaks to their preparedness and operational strength. Their disaster recovery plan was clearly well executed.
Makes you wonder, though, how they account for these unpredictable events in their financial projections.
Well, they're anticipating some lingering effects from Hurricane Helene in North Carolina, which could offset the positive impact of Largo Hospital reopening in Tampa. So it's definitely a bit of a balancing act.
Speaking of balancing acts, let's talk about those Medicaid supplemental payment programs. They really gave HCA a nice boost this year.
Oh, yeah. They saw a net benefit of $400 million from those programs in 2024, exceeding their initial expectations.
Wow. But they're not expecting that same level of support in 2025. Why is that?
It's partly due to some one-time payments they received in 2024. And there's always some uncertainty with government programs, right? So they're projecting that these programs will either stay flat or even become a headwind of up to $250 million next year.
So cautious optimism, but also prepping for a potential hit. Got it. What about volume trends? What did those look like?
Really solid across the board. Same facility inpatient admissions are up 3%. ER visits jumped 2.4%. And even inpatient surgeries rose by 2.8%.
Wow. Those are some healthy numbers. What's driving all that?
Well, part of it is likely the favorable payer mix. They're seeing a good balance of patients with different types of insurance, which is good for their bottom line.
So it's not just about seeing more patients, but the right kinds of patients?
Exactly. Though outpatient surgeries actually dipped a little bit, down 1.3%, but revenue from outpatient services remained strong. Again, thanks to that payer mix.
Interesting. So fewer outpatient surgeries, but more revenue from them. How does that work?
It could be that they're focusing on more complex and higher paying procedures.
Smart move. Now, what about operating costs? Did they manage to keep those in check?
For the most part, yeah. They were pretty much in line with expectations. However, their adjusted EBITDA margin, which measures profitability, did take a slight hit. It declined by 60 basis points compared to last year.
Not ideal. What caused that?
Well, those hurricanes we talked about played a big role, especially the impact on Largo Hospital in Florida and the ongoing effects in North Carolina. It's tough to keep margins optimal when you're dealing with disruptions like that.
That's fair. So let's talk money. Cash flow investments, all that good stuff. What kind of numbers are we looking at?
HCA generated a whopping $10.5 billion in cash flow from operations in 2024. That's an 11% increase over the previous year.
Wow, that's a lot of cash. What are they doing with all that?
Investing heavily. Capital expenditures for the year totaled $4.9 billion, with significant spending on network development, capacity expansion, and clinical enhancements. Things like new facilities, equipment upgrades, and new technologies.
Sounds like a serious commitment to growth and improvement. But what about shareholders? Are they seeing any of that cash?
Absolutely. They repurchased about $6 billion of their own shares and paid out $690 million in dividends. They're definitely focused on creating shareholder value.
So investing in the future, rewarding shareholders, and still managing to grow profits despite some serious obstacles, that's impressive.
Yeah. And to really show their confidence in their financial strength, they're actually lowering their targeted leverage ratio. That's a measure of debt compared to earnings. They're aiming for a range of 2.75 to 3.75 times, which means they're comfortable taking on a bit more debt to fuel future growth.
Interesting. So what's their secret? How are they pulling all this off?
They've got a very strategic approach. One key initiative is their focus on operational efficiency, doubling down on case management and improving patient throughput in their hospitals, especially for those with Medicare Advantage plans.
Streamlining makes sense. Definitely helps the bottom line.
Right. They're also expanding a program from their ERs to optimize operating room usage, all about making things run smoother and keeping those surgeons happy.
Happy surgeons, happy patients, happy investors. Everybody wins. So they're working on internal improvements, but are they doing anything to expand their reach?
For sure. They're actively pursuing network development through capital investments and some targeted acquisitions. They've even got a new hospital acquisition in the works up in Manchester, New Hampshire.
Expanding their footprint. Smart move for long-term growth.
Definitely. And they're not forgetting about their workforce either. They emphasize their ongoing efforts to keep employees engaged, reduce turnover, and promote workforce development. They even mention some early successes with AI to streamline administrative and operational processes.
Wait, hold on. Did you just say AI? Like artificial intelligence?
You heard right. They're even exploring how AI can be used to enhance clinical processes. Pretty cutting-edge stuff.
That's amazing. It sounds like they're really embracing innovation and staying ahead of the curve.
It's a fascinating approach. They've got a balanced approach to growth, combining these innovative initiatives with strategic acquisitions and a solid focus on their core business.
So playing the long game while keeping an eye on the future sounds like a winning formula to me.
Definitely. So with 2024 wrapped up, what does their outlook for 2025 look like?
Well, they've given us some guidance, but I'm sure you're itching to break it all down for us. Hit us with those projections.
Okay, so for revenue, they're projecting somewhere between $72.8 billion and $75.8 billion.
That's a pretty wide range, though. Why is so much variation?
Well, you've got several factors. The political landscape, for one. The new Trump administration and their healthcare policies could have a big impact, especially their views on the Affordable Care Act and those enhanced subsidies.
Yes, politics, always a wild card. So are they factoring in potential cuts to those subsidies?
Hard to say for sure. They're actively advocating for their continuation. It's had a positive impact on enrollment in the state health insurance exchanges, but they're also preparing for the possibility of those subsidies being reduced or even eliminated. So that uncertainty definitely contributes to the wider revenue projection.
Makes sense. What about earnings? What are they estimating there?
For adjusted EBITDA, they're projecting between $14.3 billion and $15.1 billion. And for diluted earnings per share, the estimates are between $24 or $5 and $25.85.
So still profitable.
Mm-hmm.
But maybe not the same level of growth as we saw in 2024.
Right. It seems like they're taking a cautious approach, factoring in those potential policy changes and other uncertainties we've talked about. They're also planning to continue investing heavily, with capital expenditures projected at around $5 billion to $5.2 billion next year. So not shying away from growth, but being realistic about the challenges they might face.
Sounds like a smart strategy, balancing optimism with prudence.
Exactly. Now, you mentioned political shakeups earlier, and there's one policy issue in particular that I think is worth digging into a bit deeper: site-neutral payments.
Site-neutral payments.
Okay.
To be honest, I'm not totally clear on that one. Can you break it down for us?
Sure. So it basically means that Medicare would reimburse hospitals the same amount for outpatient services, regardless of where they're provided. So whether a patient gets a procedure done in a hospital outpatient department or a freestanding clinic, the payment would be the same.
Okay, I see. So what's the HCA stance on this? Are they on board?
Not really. They've actually been pretty vocal in their opposition to these kinds of cuts to hospital outpatient reimbursements. They argue that hospitals have higher operating costs than freestanding clinics because they have to be ready to handle emergencies and more complex cases 24/7.
That makes sense. Hospitals are kind of like the ERs of the healthcare system. Got to be prepared for anything. And that comes at a cost.
Exactly. So HCA believes that site-neutral payments don't accurately reflect the reality of healthcare delivery and that they could end up hurting hospitals financially.
So a potential threat to their bottom line.
Potentially. But they're actively involved in advocacy efforts to push back against these policies. And they're exploring ways to adapt their operations to mitigate the impact.
Sounds like they're not just sitting back and waiting to see what happens. They're taking proactive steps to protect their interests.
Absolutely. Now let's go back to those impressive volume increases we talked about earlier. What were your biggest takeaways there?
Well, the overall increases are pretty remarkable. But what really stood out to me was the growth in inpatient admissions, especially considering they mentioned a weaker respiratory season this quarter compared to last year.
Yeah, that is interesting. It suggests that their core business is strong, even without the seasonal fluctuations that can impact hospital admissions. There are probably other factors contributing to that growth too, like demographic trends and the rising prevalence of chronic conditions.
Maybe they're also benefiting from some of those strategic initiatives they've been implementing, like their efforts to optimize patient flow and improve efficiency.
It's certainly possible. It seems like their focus on operational excellence is paying off.
So growing volume, managing costs effectively, and investing in the future. That's a solid recipe for success.
I agree. But let's not forget about those potential headwinds we discussed, particularly those policy changes. It'll be interesting to see how they navigate those uncertainties in the coming year.
Definitely. But before we get too serious, how about we have a little fun? It's time for our favorite segment. This is not financial advice, where we toss out a wild, speculative, just-for-fun freight idea inspired by the earnings call.
All right, let's hear it. What crazy, outlandish, definitely not investment advice scenario are you dreaming up today?
Okay, so remember how HCA mentioned their early successes with AI? Well, what if, and I know this sounds far-fetched, but what if they actually become the Google of healthcare?
The Google of healthcare. Interesting.
Yeah, so picture this: HCA develops this revolutionary AI-powered platform that completely transforms healthcare. It could be anything from a super efficient patient scheduling system to a diagnostic tool that can predict health problems before they even show up. And then they license this platform to other healthcare providers all over the world, becoming the go-to solution for hospitals and clinics everywhere.
So you're thinking HCA pivots from hospital operator to tech giant. That's a bold prediction.
Right. And if they can pull it off, their stock could skyrocket. Of course, this is all purely hypothetical and super speculative, but it's fun to imagine the possibilities.
Just to be clear, this is purely for entertainment and should not be taken as actual financial advice. But it does illustrate the potential for disruption and innovation in healthcare.
Exactly. Sometimes you got to think outside the box and imagine those what-if scenarios to really grasp the potential of a company like HCA.
That's a great point. It's about understanding those long-term trends and picturing how companies might adapt and evolve to take advantage of them.
All right, so back to reality. What are your final thoughts on HCA's overall performance and outlook?
Well, even with those potential challenges on the horizon, I'm actually pretty impressed with their performance. They've shown incredible resilience in the face of those hurricanes, and they're clearly committed to investing in future growth, both through capital expenditures and those innovative initiatives we discussed.
I agree. They're also striking a good balance between rewarding shareholders with dividends and share buybacks, while also making those crucial investments in their business.
Right, and they seem to be very aware of the potential impact of those policy changes and are being proactive about addressing them.
So they're not just crossing their fingers and hoping for the best. They're actively shaping their own future.
Exactly. They're a company that's willing to adapt and evolve to stay ahead of the game, which is always a good sign for investors.
So bottom line, they're a company worth keeping an eye on.
Absolutely. They're definitely one to watch in the healthcare space.
Yeah, it sounds like they're in a good spot to weather whatever comes next,
Yeah.
even with all the uncertainty out there. But before we wrap up, I've got one more thought for
Right. And I'm listening.
you. We've talked a lot about HCA and AI. It's definitely changing the game in healthcare. But like any new tech, there are always ethical considerations.
For sure, AI has the potential to do a lot of good. But there are questions about privacy bias and even how it affects the human element in healthcare.
Exactly. So I'm wondering, what role do you think HCA can play in shaping the ethical guidelines for using AI in healthcare?
That's a great question. As a leading provider, they're in a unique position to not only implement AI responsibly, but also to advocate for ethical use across the whole industry.
Right. They could really set the standard for how AI is used in healthcare, making sure it's enhancing patient care, not replacing human connection.
Imagine them taking the lead on safeguards against bias in AI algorithms, or championing data privacy in a digital healthcare world.
It's not just about the tech. It's about using it the right way.
Yeah.
And HCA, with their resources and influence, could really make a difference.
Definitely. It's exciting to think about the impact they could have, not just on their own patients, but on the entire healthcare system.
Well said. And on that note, I think it's time to wrap up. Thanks for joining us on this deep dive into HCA Healthcare's Q4 2024 earnings call. We hope you found it insightful and informative.
As always, remember, this is not financial advice. Do your own research, talk to a professional, and invest wisely.
And until next time, happy investing.